Hello ladies and gentlemen, Jay Tyler here. Welcome back to Jack Fund Management. Price action this week is showing a lot. Great stocks like Owens & Minor, ticker OMI, and Biotechs, ticker BNTX, soared, while any businesses fundamentally stalling remain negative to flat at best. Investors do a lot of calculations. Awaiting a multiple compression, S&P earnings stand at around 2022 forward. Many expect it to come down to around 16 times. For that to take place, largely driven by bond markets, at 1.25, that points us to earnings. We have all heard about CPI, PCE running hot, Case-Shiller running sky high. We feel unsure who can argue it has nothing to do with this fact that 21% of all US dollars got printed in 2020 alone. BioNTech and many powerhouse biotechs sparkle here. Come rain or shine, drug makers have a reputation of regularly raising prices. If one requires a drug, they have to pay. World governments obsessed with this virus and variants such as Delta around BNTX has a position to answer this call. BioNTech trades at only 7 times earnings. They have success up like Bezos in space, wildly positive. In this landscape, especially, investors look for growing sales, growing margins. Contrasted with Tesla, margins in a microscopic margin sector to begin with have shrunk. It claims a barely 6% ROE, showing disrespect for shareholder returns and inefficiencies. No other metrics could really logically apply either. P.E.G. and so on. Revenue has not kept up pace, and EV to EBITDA slips at 132. Tesla also does not return what it costs in capital, losing value. We feel glad we shorted it back then at about 780, 750 range. This does not look like a 2019 Tesla story with abnormal EBITDA, not in a former 2019 state where it had nobody around, where it went from 0.61 billion to 0.52 billion, and now decelerated tremendously. Basically, one just has so many hundreds of far better businesses from which to choose. Apple, ticker AAPL, has generated an annual ROC of 33.71%. With this sky-high figure, they create value. They create excess returns, increasing value as they enlarge. Apple looks spectacularly perfect from dozens of angles. A Graham formula puts it at about $230 per share. DCF models have it undervalued by nearly 5.8%. Apple has captured more R.S.p.G over this year, TTM trailing 12 months, than 3 years prior to that. Furthermore, in a world full of SPACs, Tesla's unprofitable businesses, a quality Beninish M score on Apple commands such attention. Group 1 Auto, ticker GPI, has ample liquidity, a PS second only to AutoNation Inc., profitability, and efficiency prowess. In a far more fairly price-conscious market, a PE at 8.36, 31.43 less than these broader S&P indices, it will not stutter. No froth at all here. Priorities really altered with this virus. Personal vehicle demand really came into vanguard. GPI has insider buying, more share repurchases. This industry may stay more lean, not oversupplying. 88% of middle market business leaders feel optimistic going into these next 6 months. Justified forward PE models put Group 1 at around $173.39. Merrill Lynch even has a 305 target with such glaring tailwinds. Our proprietary DCF models indicate Carrier Global, ticker CARR, as extremely favorable. With abound services, radical demand for H.V.A.C/R systems, they have raised the dividend by 6.5%, with revenue consensus estimates of way past $14 billion by year-end 2023. Facebook, ticker F.B., trades way under intrinsic value. Of course, it has value to earning when most of this internet content industry has a far negative PE. They have oceans of operating cash flow, as they significantly increased margins over this year, giving long-standing shareholders boatloads of comfort, more total equity, cash, security, assets than even in Amazon minus liabilities. It transforms more of each dollar into profits, literally having no long-term debt. They grow ARPU worldwide. We love non-cost intensive enterprises, and in terms of net income conversion ratios, FB smashes it, as well as HubSpot, ticker HUBS. FB strongly and widely used in emerging countries, E7 economies, GDP by PPP, purchasing power parity, could easily surpass Germany and even UK in upcoming years. We love logical growth at reasonable prices, and Facebook locates growth all over every continent. For instance, FB embeds itself as a worthwhile service in many cultures effectively, while Tesla has gone seen as not a value at all in Europe. Moodys had a phenomenal first quarter. They, as so many first-rate businesses, raised 2021 guidance. Investors thirst for this certainty. They gave pumped forward guidance, glisteningly positive outlook, and have an integral business in credit ranking. It will expand into E.S.G ranking services, a highly politically leveraged and powerful tool. We still like many banks, of course one has to have prudence and an advanced strategy to select wisely. It likely will add circumspect to have PE in teens positions instead of just no profits or half a grand PEs. Specialized REITs continue to crush it. Anyone with actual skill in commercial and residential estate has orchestrated a wealth-making rebound. Cloudflare does have to ramp up earnings, while it has an insanely exceptional revenue forecast, though of 28.8%. Juxtapose that next to a US software industry average of near 11.4%. This makes a clear decision. This earnings season environment, where beats and powerful guidance reign supreme, more of this to come can set up a big bull leg. With less workers, live person, ticker LPSN, comes in. More and more conglomerates have turned to automation for simple replacement, especially this conversational AI business, as Ring got acquired by Zoom to just grab onto each customer, as each has granted LPSN a brilliant ARPU of 35% year over year. This solidifies live person as a key frontrunner in a hot M&A category. Apple has margins all around at 30+%, meanwhile gross margins on Shopify, ticker SHOP, 52%, and coming in at over 50 for 3 consecutive years keeps impressing. They have earnings this month. We reiterate that markets have shown such beautiful resilience, and anyone spouting alarmism, Shilling, Hysteria, etc. obviously has terrible entry after terrible entry, on top of not really having any idea how to get in. Just going forward, a couple of multi-trillion-dollar corporations more than glue indices together. Markets keep grinding higher. We chuckled a bit when Josh Brown said those shills trying to grift red mania looked like they embarrassed themselves. We often watch out for those pushing red madness or panic selling craze. With Fed talk and more earnings up ahead, most corporations held onto staggering profit margins in 2020. Now they look to see who can keep and grow profit margins. Dividend increases, share repurchases, and outlook all matter. Meme names actually may come from technology and pages like this, rather than strictly froth. Of course, payment for order flow and business models like Robinhood trading did not come fully free. Make a cap in a driver's seat, as well as semiconductors dictate positively to this market. A lower Fed denominator rate, a higher supported evaluation. Went up over 12% in a year, we see gains into year end. Often sensationalists shouting red, just always had and get terrible entries into everything. Always overpaying, this clarifies that. Disney brought in wild cash to Black Widow and Disney Plus. Content creators now even more so realize they can sell D2C and have unparalleled reach coupled with streaming. Data shows that spending on gyms has ran at about 65% of that at 2020 levels. Most industries have rebounded and or normalized, even grown. At-home gyms may in many respects get replaced with at-home options. Many have built at-home fitness habits. We saw a bit different policy response. Forcefully, we may see a bit different cycle shape. 2/3 of S&P 500 market cap companies actually grow faster post-pandemic, accounting for about 60% of sales and the same proportion of profits. They, in reality, hover above trend line. Saying this recession ceased about early this year, a quarter or two through, everything gets priced in so rapidly. With information everywhere, shapes can look more sharp. Multi-month bears could look far more unlikely. An opposite reaction of a taper tantrum, as Powell mentioned post-FOMC, long rates actually declined. And as CPI showed largely virus-impacted sectors, labor force participation rate has not risen. This may turn out as an infinite errand. We greatly appreciate you all in making us 700 subscribers. Next stop, 1,400 and more. We of course love and feel honored to give you all quality, clear insights and information as well as crucial news on markets. Join us, join Jack next time.